Ever wondered about the difference between long-term and short-term investing? If so, you're in the right place. Investing is all about putting your money to work today so it can grow and provide for you tomorrow. Now, when it comes to the duration of the investment, we commonly hear about two types: long-term and short-term. Long-term investing typically involves holding onto your investments for several years, capitalizing on the power of compounding and market growth over time. Short-term investing, on the other hand, is more about making quick gains by taking advantage of market fluctuations. And while these concepts apply to all kinds of investments, today we're going to focus on two specific areas: stocks and cryptocurrency. But before we dive in, remember that we're not financial advisors. Always do your own research before making any investment decisions. Long-term investing, what does it mean exactly? Well, it's a strategy where investors purchase assets with the intention of holding them for an extended period of time, typically years or even decades. The aim is to let your investments grow over time, taking advantage of the power of compound interest and the natural ebb and flow of market trends. Now let's talk about the benefits of long-term investing. The first is the potential for significant growth. The stock market, for instance, has historically provided an average annual return of around 7 to 8%. Over the long haul, this can lead to substantial wealth accumulation. The second benefit is the reduction of risk. By holding investments for a longer period, investors can ride out market volatility and downturns. And the third is tax efficiency. In many countries, long-term investments are subject to lower capital gains tax rates. But it's not all sunshine and rainbows. Long-term investing also has its drawbacks. The first is the lack of liquidity. Your money is tied up for a long time, and accessing it can be difficult and costly. The second is the potential for loss. If a company goes under or a sector declines, your investment can shrink or even disappear. And the third is the need for patience and discipline. It can be hard to stick with your investment strategy when the market is fluctuating wildly. When it comes to strategies, long-term investors typically focus on fundamental analysis. This involves evaluating a company's financials, industry position, and market trends to determine if it's a good investment. For cryptocurrency, it's a bit different. Long-term crypto investors often look at the technology and use case of a particular coin, as well as its adoption and regulatory environment. So what about long-term investing in stocks versus cryptocurrency? Well, stocks are generally seen as safer, but potentially lower return. Cryptocurrency, on the other hand, is more volatile but has the potential for massive returns. Both have their place in a diversified portfolio. So that's long-term investing in a nutshell, but what about short-term investing? Now, let's shift gears and focus on short-term investing. Short-term investing is a strategy where investors buy and hold assets for a short period, typically less than a year. It's like a sprint in the investing world, where the goal is to make quick profits from market fluctuations. The main advantage of short-term investing is the potential for rapid returns. You can invest in a stock or cryptocurrency, and if the price goes up in the next few days or weeks, you can sell for a profit. It's a fast-paced and exciting strategy that keeps you on your toes. But with great potential comes great risk. The stock and crypto markets can be volatile, and prices can swing wildly in short periods. You might buy a stock or crypto hoping the price will rise, but instead, it falls, leading to losses. It's like riding a roller coaster, thrilling but nerve-wracking. Short-term investing also requires a lot of time and attention. You need to constantly monitor the market, be aware of news that could affect prices, and be ready to buy or sell at a moment's notice. It's not for the faint-hearted or the time-strapped. There are several strategies for short-term investing, like day trading, where you buy and sell within the same day, or swing trading, where you hold for a few days or weeks. The choice of strategy depends on your risk tolerance, time commitment, and investing skills. Now, how does short-term investing differ in stocks and cryptocurrencies? Well, the principles are the same, but the dynamics are different. Stock markets have set trading hours and are regulated by financial authorities. Cryptocurrencies, on the other hand, can be traded 24/7 anywhere in the world and are less regulated. This makes crypto markets more volatile but also potentially more profitable. With that, we've covered the basics of both long-term and short-term investing. But how do they stack up against each other? Now that we've got the basics down, let's compare long-term and short-term investing. First off, it's crucial to understand that both long-term and short-term investing strategies come with their own set of potential rewards and risks. The choice between the two often boils down to an individual's financial goals, risk tolerance, and time commitment. Long-term investing is often seen as the more conservative approach. It involves buying and holding assets, like stocks or cryptocurrency, for an extended period, typically years or even decades. This strategy banks on the idea that despite short-term market fluctuations, the value of these assets will increase over time. It's a bit like planting a seed and patiently waiting for a tree to grow. Sure, it takes time, but the rewards can be substantial. On the flip side, short-term investing, often referred to as trading, involves buying and selling assets within a much shorter time frame, sometimes within a single day. This strategy seeks to capitalize on short-term price fluctuations and trends. It's more like a fast-paced game of chess, where you're constantly making moves, trying to outsmart the market. Now let's bring stocks and cryptocurrency into the discussion. Stocks have been around for centuries, and they're widely regarded as a cornerstone of long-term investment strategies. They offer dividends, voting rights, and the potential for steady growth over time. Cryptocurrency, on the other hand, is a relatively new player in the investment world. Its volatile nature can provide opportunities for significant short-term gains. However, it's also possible to hold cryptocurrency as a long-term investment, with the belief that its value will significantly increase over time. Just remember, with greater potential rewards comes greater risk. So, which strategy is more suitable for you? Well, that depends on a few factors. If you're someone with a lower risk tolerance, who prefers steady growth and has the patience to wait, long-term investing might be your best bet. This strategy often requires less time and stress compared to the constant decision-making involved in short-term trading. However, if you thrive on excitement, have a higher risk tolerance, and are willing to dedicate more time to research and making swift decisions, then short-term investing could be a good fit. Just remember, it's essential to stay informed and be prepared to adapt quickly to market changes. In the world of investing, there's no one-size-fits-all strategy. You may even find that a combination of both long-term and short-term strategies works best for you. For example, you could hold a core portfolio of long-term investments while also engaging in short-term trades. As you can see, both investment strategies have their own merits. It's all about finding what works best for you. So, what have we learned today? In our deep dive into the world of investment, we've mapped out the terrain of both long-term and short-term investing. We've seen how they differ, how they overlap, and how they play out in the arenas of stocks and cryptocurrency. Let's take a moment to circle back and touch on the key takeaways. Long-term investing, as we've seen, is akin to a marathon. It's about endurance, patience, and the ability to weather the ups and downs of the market. It's a strategy that involves holding on to assets for several years, capitalizing on the principle of compound interest and the general upward trend of the market over time. In the world of stocks, this has traditionally been a tried and true method. But we've also seen how it can work in the realm of cryptocurrency, with Bitcoin being a prime example. On the flip side, short-term investing is more like a sprint. It's fast-paced, requires agility, and a keen eye on market trends and fluctuations. It involves buying and selling assets within a short time frame, sometimes within a single trading day. This style of investing can provide quick returns, but it also carries a higher risk. Both stocks and cryptocurrencies can be traded in this way, although the volatility of the crypto market can make it a more high-stakes game. However, it's vital to remember that neither of these strategies is inherently superior. The best choice depends on individual factors: your financial goals, risk tolerance, time commitment, and market knowledge. It's also crucial to remember that investing should never be a gamble. Always make informed decisions based on thorough research. And remember, we are not financial advisors, so you should always do your own due diligence. In the end, whether you're a long-term investor watching the slow and steady growth of your portfolio or a short-term trader thriving on the pulse of the market, the world of investment is a thrilling journey. Thanks for watching. If you found this video helpful, be sure to like, comment, and subscribe. And don't forget to hit the bell notification so you'll get updates anytime we upload a new video.